this next session, our panelists will share their views on what they see as the most compelling opportunities, the key risks that they anticipate, and the investment themes likely to emerge in the coming months. Let us now invite our moderator, Howard Lee from the HKMA, and our panelists, Jonathan Gray from Blackstone, Ron O'Henley from State Street, Ted Pick from Morgan Stanley, Marc Rowan from Apollo, and David Solomon from Goldman Sachs. Thank you, Howard. Over to you.
Thank you very much, ladies and gentlemen. Now we move to the next panel, which is talking about the market trends and opportunities. Just a little bit of recap. When we enter this year, 2024, many investors expected a pretty roller coaster ride, probably because a lot of things are going to happen at that time. Like almost half of the population will be going through a major election, and the very likely pivot of the major central banks in the year. Now, what it turned out that for investors, it was a pretty robust start of the global markets, and then fueled by very strong growth and excitement around AI, and also it drove a lot of developed market equities to all-time highs. At the same time, US yields rose in the first 6 months, and inflation continued its trajectory towards the 2% target. Now, since then, we have experienced a period of pretty heightened volatility, with the rates market undergoing significant repricing and 3 major central banks cutting rates. Closer to home in Asia, China announced a series of stimulus packages while Japan initiated its policy normalization. Now the year's biggest political events have mostly taken place, and a soft landing in the US is largely priced in. Perhaps it's time for us to revisit the outlook for the coming year and what are the risks and opportunities lying ahead, both from a macro perspective, and I will try to also touch on a few market structure points going forward. When I listened to the previous panel, I heard Arthur put a question about fiscal deficit, and I thought he had a hard time prompting the panelists to pick up the microphone to talk about this. So perhaps I want to come back to this. This must be a pretty difficult question. And I recall, in fact, Ron, during the Milken conference in May 2024, you mentioned that the US is expected to manage its deficit situation. Otherwise, we might face serious issues in 5 years. With the elections now over and the proposed policy that we have heard, would likely try to increase spending and cut taxes. These are things that might not be very conducive to containing the deficit. So what's your current view on the prospect of achieving a sustainable fiscal path in the US, and what implication do you foresee for the markets and investors? Ron.
Well, that's a big question, and I think what I said was, I don't think I said I expected the US to manage the debt situation, but I thought it was imperative that it start thinking about it. I mean, listen, debt levels in the US are at an astounding level. I think we all know that. And if you think about the fiscal and economic situation that we've been through, these levels of debt make no sense, given the kind of growth and the economic prosperity that the US has had. 99% of GDP, probably approaching something around 125% of GDP within 10 years. And at the same time, this has happened when interest rates are going up, right? So the cost of debt and the cost of servicing the debt is likely to double over the next 25 years. What was it's even more astounding to me, though, is if you think about all the words that were spoken in this last election, does anybody recall anybody saying anything about debt? I don't. I don't think anybody did. And so if you looked at the word cloud for debt, you saw the white space, that was debt, because it was never spoken. So this is a real challenge. And the trouble for politicians is, in US politicians, is the US has this incredible position as the reserve currency. So this is one of those problems that's not apparent and can easily be kicked down the road. But we just don't know how long this can last. What we do know is these numbers have never been seen before. And what we do know is that at some point, but we just don't know when, the holders of the debt are going to react. And they're going to put a premium on this. And if you think about the breadth of the Treasury market, how important it is to virtually everybody in this room, and what it would mean if you started to get wobbles in that market, what it would mean for financial markets beyond that. So I don't think this is a problem that that we can wait until it manifests itself, because if it manifests itself with the kind of privileged position the US has, I think we're in real trouble. So to me, it is time for somebody to come forward. I did think if I were advising Kamala Harris, I would have said, you should talk about this, because nobody would have expected a Democrat to talk about it. But she's not the president. President Trump will be coming in, and I think at some point it is important that he address this. And how we do that is the bigger problem. We've been down this road before. Simpson Bowles was actually a pretty good effort, and we got right to the finish line there and then did nothing. But it's very, very hard to imagine that the kind of spending that we're talking about and the kind of tax path that we're on is actually going to enable us to get to a point where we can have and maintain sustainable debt levels.
Yeah, well, that's a very good analysis, but I just want to put to you or any panelists that at which point do you think investor would start to get nervous about this and ask more and more questions about this? Ron?
I mean, I'll start, but there's plenty of people here that can add. I mean, I think any kind of a failed auction or an auction in which we didn't see the take-up in treasuries that we thought, it doesn't take a lot. I mean, think back to COVID, think back to the financial crisis, what it was that was starting to rattle these markets. So I don't think it would take much to do that. But I mean, the challenge now is everybody believes there's plenty of solutions, right? If things get really bad, the central bank can go back to quantitative easing and just continue to buy up debt. But what we don't know, because it's uncharted territory, is how long this can last.
I see. So David and Ted, do you receive more inquiries about this from your clients?
I certainly think in the investment community, in the professional investment community, there's a lot of focus on this issue. I agree with what Ron said, that the preeminence of the US dollar gives the United States enormous runway and latitude to be very patient about how this is managed. But ultimately, you know, there are only a handful of ways out of this, especially if we continue on the same fiscal path. And so, you know, you can run a more aggressive growth strategy. And if you run a more aggressive growth strategy, that can compensate. I think people are watching this. I don't think we're at a place where there are alarm bells, but I do think we've grown the debt stack in the United States very significantly. We've kind of grown it 4.5 times in the last 15 years. Just refinancing the current stack at today's levels continues to grow it through the rest of this decade. I think we've got a lot of latitude given the preeminence of the US dollar. But at some point in time, there'll be some event that creates more focus around this if we don't create a growth strategy that allows the current trajectory that we're on to rebalance in some way, both a growth and spending strategy to allow it to rebalance.
Okay, very good. And for a reason, you know, I'm not putting this question to Marc, but if you volunteer to answer it, I don't mind.
I was so happy to see Ron on the hot seat here.
Okay, perhaps I turn to Ted for a question that's slightly different, but a related question. And I look at my record, and I find out that you say a couple of times that we are seeing the end of financial repression. Now, when you said that, what was the most important market shift that you had in mind when you keep mentioning this? And now with the general expectation about the U.S. fiscal situation, very little political appetite to really contain the deficit. And on the other hand, a few inflationary factors seem to be coming up and going in force, like supply chain rewiring, climate transition and higher military spending and aging population. Now, are you worried that some form of financial repression would be creeping back in with inflation moving up faster than short-term rates? And how should firms like Morgan Stanley position themselves for such changes?
I think that was Ron who said that. Well, we had 15 years of zero rates and zero inflation, and something was going to happen eventually to take us off of that. And that event, of course, was the pandemic 5 years next spring, and then the remediation and the stimulus, and then, of course, the unleashing of populism that came on the back of that. And you're right that there are ongoing inflationary themes that bear consideration. Some element of deglobalization, ongoing climate transition, the muscularity of the nation state or regional alliances, i.e. defense, war, those are all inflationary. And it is also the case that there are 3-4 years of a cohort in the US that never actually received the stimulus but received the inflation. And then there are others still who drew down on their stimulus and are not asset owners, and so they need to be minded as well. So in a sense, there is an inflationary backdrop, and there is now the additional complication of the potential for tariffs, and actually net emigration also would be inflationary. But we have to put that against the reality that the consumer and corporate community, by and large, is in very good shape. The economy continues to grow, and that is a good thing. And the reality is that the bond vigilantes are out there, and they will be looking at the long end, but we should bear in mind that the long-term Fed funds rate for the last 80 years or so is about 4%, and it would not be unreasonable to think that terminal rate could be 3 to 4%. So the Fed might well be bearing that in mind as something that is normalized. I think when you put all of that together, the hot and the cold, there's enough there to conclude that the idea of going back to financial repression, if that means 0 and 0, is highly unlikely. What is that terminal rate? We'll see, but if we continue to grow, 3 to 4% is not a bad place to be. And for the Fed to move prudently, given that there will be hot and cold prints, is a smart thing to do. With respect to our business models, we raise, manage, and allocate capital, and this environment has been one where if you are in the business of allocating capital, it's been great for our markets businesses. A normalized economic environment with some level of uncertainty and some level of cost of capital, that's great for allocators. And then if you're managing capital, cash, for example, you saw that there's $7 trillion now in US money markets. Cash is a strategic asset at 4.5% or 5%. So the managing capital business in our wealth and investment management business is good. And what we're most excited about as a group is the idea that we're going to get into raising capital mode. That is the last piece of what is the hallmark of a growing and thriving economy, which is where the classic underwriting and mergers and acquisitions businesses take hold. So if you think about that against the big picture, I think financial repression is behind us, and we'll have more normalized economic conditions. And yes, the bond market is a daily check on hygiene at the sovereign level, and we'll all be watching that. But for now, it looks like a growth plan is starting to take hold, and we should, on balance, be bullish about it.
Yeah, well, thank you very much, Ted. Now, I now turn to David. Given the macro backdrop that we just talked about, what are you seeing by ways of financial market activity in the US and perhaps other regions, in particular in Asia?
Financial market activity in terms of capital raising activity, or?
Yeah.
Yeah, so the capital raising activity in the US and around the world has been muted. You know, we had an extraordinary dislocation coming out of the pandemic, and with a massive amount of fiscal stimulus, we basically took capital raising activity, market activity, to kind of peak levels in 2020 and 2021. And then with the war in Ukraine and a reset with inflation and a reset of values, we slowed that all down. And so for the last couple of years, if you look at M&A activity, If you look at equity capital markets activity, we've run meaningfully below 10-year averages. M&A activity this year has run a little less than 15% below 10-year averages. I do think there's been a regulatory overlay to that because the FTC in the United States has had an implication on those activity levels. And I think equity capital raising activity has run about 24% below 10-year averages. Debt capital markets activity this year picked up meaningfully and has run above 10-year averages. And given where we are at the moment, Spot, you're starting to unleash some of those animal spirits, and you're seeing a pickup in equity activity, pickup in M&A activity. I would say with the new administration, we'll have a different FTC. You know, all of that, I think, in 2025 should contribute to more robust levels of both capital raising and M&A, which is obviously good for the ecosystem that everyone here sits in.
Yeah. Okay, and now I would like to stay on with David, but having talked about the macro thing, I would like to move on to a little bit to talk about, like what I foreshadowed at the beginning, a structural market shift. Now, as non-bank financial firms like Jane Street and Citadel Securities are emerging and significant challenges to traditional investment banks in market making. They are taking a very, very big share of the business and growing fast. How do you see this shift affecting the competitive landscape for firms like Goldman Sachs? And perhaps Ted would like to supplement as well from Morgan Stanley's perspective.
Sure. You know, all of us on this stage have been in these businesses for a long time. Just start by saying these are super competitive businesses. They've always been super competitive businesses, and they will continue to be very competitive businesses. You mentioned Citadel and Jane Street. They have interesting businesses. You know, I'd say their focus, particularly in equity markets, on what we call anonymized flow, and the technology they've put behind that has allowed them to have very significant market share in those areas. There are certain regulatory arbitrages that exist that have allowed them to invest in game focus there. But at the same point, those are narrow aspects of the overall ecosystem that firms like Goldman Sachs and Morgan Stanley participate in. That would be interesting. Goldman Stanley, a little bit of a merger there.
I was thinking Morgan Sachs.
Wouldn't surprise you, I was thinking of Goldman Stanley. But firms like ours run very, very big, complex ecosystems where we bring, you know, a wealth of products and services that are necessary for big institutions. And, you know, I think and I look at our focus on our clients, our ability to finance our clients, our global reach, our scale. We've had significant market share gains. I think we've taken our market share in those market activities up by about 350 basis points over the last 5 years. You know, these large platforms are very capable of competing and will continue to compete. So there'll always be competition. There's always change. Technology advances change. But I feel, you know, really strongly about the value proposition that a big global organization like Goldman Sachs can provide our clients.
Yeah, I totally agree with that. Scale and global, you have to be. To run an equities business, there are three of us that have about, 60% of the top line. Just to run that business costs $4 or $5 billion a year, even before you turn the lights on. So you need global scale. And then when you look at emerging pockets like private credit, there's plenty of room for us to interact. The relationships may get more complicated at times, but our ability to source, structure, finance, manage that capital is profitable. And again, if you have the right kind of scale and resourcing, you can do it successfully.
Yeah, well, I heard you mention private credit, so this is something that I would like to touch on as well. Of course, when we talk about private credit, everybody thinks about sort of Marc and Apollo. Now, we heard a lot of these suggestions that private credit managers are really taking the lunch of traditional banks as well, and with the booming private credit market and regulators around the world, many of them also are concerned whether this is going to cause a systemic risk to the financial system with the growth of private credits being less regulated or less transparent as compared to banks lending. So, so I wanted to see your take on this, and also for Apollo, while people say that you are taking the lunch from banks, you are having some collaboration with certain banks like Citi and BNP Paribas. So do you see them as friends or frenemy or so what's your take?
So first, I consider the bankers to be very smart. So it's not just 2 banks, it's actually 12 banks. And it'll be 15 banks by the end of the year, including partnerships with many of the people here. And so we have found commonality of interest. And what's been interesting to me is the discussion with global regulators, because I think that's actually a more interesting way to come at it. We all grew up in an environment. I look at the kind of experience level in the room rather than saying age. The experience level in the room. And we grew up with an innate belief. We think private is risky and public is safe. We know in our bones that's true. And 40 years ago, which is how long ago I started, it was true. Private was 3 products: venture capital, private equity, and hedge funds. All risky, but also all in the right way, used perfectly. And public was 8,000 public companies, diversified portfolios of stocks and bonds. But what if our belief that private and risky and public is safe is just wrong? Then everything we've done in asset management for the past 40 years probably needs to be revisited. Because when something's risky, you stick it in a little bucket. You call it alternative. You watch it carefully. You want really high rates of return. But if private is safe and risky and public is safe and risky, why do we think they're any different? And the answer is it's just change, and regulators are being forced to actually address this right now. So in the US raises 50% of the world's capital. It has the most diversified funding markets. We have public markets, we have private markets, we have bank markets, et cetera, et cetera. Everywhere else in the world is pretty much limited from a capital raising flow. Europe is being forced to confront this in a major way. The Draghi report points out some of the more obvious holes in the market. And we find ourselves in an interesting dialogue now with particularly European regulators. How did they start a private market? How do they get private investors off the sidelines? And the intersection of what we do with the banking community is going to find its own level. Banks are amazingly good at some things. In asset managers, particularly long-dated asset managers like ours, good at certain things. We found our accommodation with the banking system. I think it is the regulatory landscape and the public's view and the participants' view of public and private that needs some updating. And some of the things we're doing, particularly with Ron, actually are going to call the question. I think 18 months from now, investors broadly will not actually talk about public credit and private credit. They're going to talk about credit. They're going to talk about whether something's investment grade or below investment grade. I actually don't think we're going to know the difference between public and private in 18 months.
18 months, so now maybe you're right, but the fact that people keep asking this question means perhaps we need more information, more education or whatever. So because lack of transparency or less transparency or more opacity naturally means that regulators or officials feel a little bit uneasy. So is it something that we can do more to sort of make everybody a little bit comfortable with that?
Well, I would say the following. If most places I go when I speak with regulators, almost everyone grew up as a bank regulator. Their knowledge base is as a bank regulator. Their information sources are as a bank regulator. From an investor's point of view, from a public markets point of view, banks disclose 2 lines: loans to customers, loans to companies. You click on John's website, my website, you get every holding every quarter. And so we start with a set of assumptions that private means less transparent that are just false. It's just the information is located in a different place. And so I put it back almost as a question the other way. What is the actual difference between public and private? It's not the size of issue. It's not the issuer. It's not the rating. It's not the provision of financial information. It will not be the trading and the price transparency, because New news, there is no trading in fixed income, public or private. We have the illusion of price. We don't actually have price. And what's happening is all of the tools that exist in the public market as it relates to fixed income are coming to the private market. And I think very quickly, investors are going to be confronted with the fact that what's different is something in their mind, rather than something that's real.
Howard, I just want to pick up on the first part of your question where you said that the bank regulators are concerned about the rise of this phenomenon. I would argue that the bank regulators have gotten exactly what they wanted here. Coming out of 2008, there was this view that banks were enormous concentrators of risk. And we saw what happened with the bank failures. And what they've done through various re-regulation capital rules is they've taken a lot of that risk out of the banks. They've basically unenabled banks to lend as much as they can. And what you've got now in private credit is actually a distribution of risk. It is not concentrated in institutions. It's not to say that there aren't new risks arising, but bank regulators have gotten exactly what they wanted in terms of less concentration of risk in banks and distribution of that risk more broadly.
Okay, thank you very much. That's very helpful. Now, I'm now turning to John. Of course, you have your credit strategy, but I'm not going to ask you about credit. Of course, ask you about commercial real estate. That's another sexy subject. Now, I remember that you talk about the headwind at the summit last year for the real estate sector. And we also had another fireside chat, I remember very clearly. You told me that we can fall in love with everyone, we can fall in love with everything, but don't fall in love with our investments, including our real estate investment. So we need to cut it when we need to. But in recent months, you reiterated that investor should invest before signs are all clear. So you really think that it's time to really mend relations with our old love here?
Yes, I think you should rekindle your love with real estate. And I would say going back in January, we said publicly we thought real estate was bottoming. We've invested now, over the last 12 months, $30 billion in the space, which is a reflection of our very high conviction here. And the question is why? And I'd say first it starts with underlying fundamentals in real estate are pretty good. In most of the sectors, in logistics and rental housing, where we focused our investing, vacancy rates are 5%. Cash flows have continued to grow, even through this difficult period, albeit at a slower rate. Now, the office sector, as we know, post-COVID, has had a lot of challenges. But the rest of the commercial real estate market has generally held up. What hit the market was a sharp increase in cost of capital. Base rates went up, spreads widened a ton, cap rates or unleveraged yields on real estate went up, and that caused the decline in value. And if you look back about a year ago, things sort of reached their peak in terms of negativity in real estate. And since that time, we've seen total borrowing costs probably drop 35% or more. We have seen the commercial mortgage-backed securities market reopen. It's up fourfold over where it was a year ago. Transaction activity's picking up. There are 2 or 3 times more bidders showing up at auctions. That's obviously positive. And then longer term, real estate's about supply and demand. And you've seen new construction and things like warehouses decline, new starts decline to 80%. And that creates a foundation for the ultimate recovery. So I think for investors, it's hard because there's still a lot of bad news in the system. They've taken losses, and they tend to want to wait for that all clear sign. But if you went back to the financial crisis, you wanted to start investing in real estate in 2009. If you went back to the early 90s and 92, those couple of years coming out were when you saw the best returns, where you're still feeling a little more uncertain. And I would say today we're in a similar period of time, so we choose to lean in.
Right. So do you see different pockets or different verticals in the kind of a real estate sector that you would particularly like or less like?
Well, as I said, you know, the fundamentals and logistics driven by the move to e-commerce have continued to be strong. We like that on a global basis. We're the largest investor. Rental housing, since the financial crisis, we have had a real shortage of building. It's one of the issues in most of these developed market elections is the shortage of housing and the cost of housing. And that, of course, has translated into pretty good rental growth. And I think coming out of this, again, new construction's come down, so we still like that space. The hotel business, again, people are going to travel. We've seen less construction there, so we're bullish. And then in the office sector, I think you've got to be a little more selective, given the capital needs and the underlying vacancy, but maybe buying some of the best buildings at favorable prices, maybe through debt, that could be attractive. So I'd say we generally see the landscape is pretty good at this moment. And of course, in 2 or 3 years, it'll be less good after you've had a number of good years of returns and more capital will pour in.
Well, I drew on this one more point and then open up to see whether other panelists has other view as well. Is you didn't mention AI's kind of a data center. You are sort of putting big money into this data center, but now it's an AI craze and then everybody putting a lot of money in it. But some people say that, oh, the monetization model is still pretty unclear. So do you think this is too much money into it? Is it a bubble going on?
Yeah, I should have mentioned data centers. That is our biggest theme across the entire firm. It's really the physical manifestation of the digitalization of our lives. If you think about data storage, if you think about cloud migration, and of course AI, it happens at the data center. That is where those GPUs sit and communicate with one another, and the needs for compute power are enormous. And so we have gone out and now have $70 billion of leased data centers, a pipeline of another potential $100 billion we could build. We're doing it in the US, in Europe, in Asia. We're doing it in equity. We're doing it financing. We continue to be quite bullish. I think the real question is this like the railroads in the 1880s in the United States where there's a great underlying trend of demand, but it's going to be swamped by new supply, which kills the returns? And I'd say in that regard, there are two protections. One, you don't go out and speculatively build a data center like condos in Miami because there are only 4 or 5 tenants leasing, and the cost of these centers is quite extensive, and you have to customize in many cases. So it's $1 billion. So we're not seeing the kind of speculative building that kills returns. The second thing is that we've got a global shortage of power, and that is going to become more and more acute as we electrify everything. First with these digital assistants and AI, and over time with robotics. And when you go out today to build a data center, in many places you can't. And so if you're a developer, you have the know-how, the zoning, and of course the access to power, you're in a unique spot. So this is a space we like a lot, and we will continue to be all in as it relates to digital infrastructure and data centers.
Yeah. Yes. Marc, you have anything to add on this topic? And
Look, I think John certainly has identified the trend, but I'll simplify. For us, data centers is one real source of demand. Energy. In the US, we're talking about energy transition, but we're now talking about energy accretion. We're going to build lots of power. We're building infrastructure. There is so much demand for capital. I think of this in terms of debt and equity. There are just so many underlying drivers. In some of the markets, I think you want to be debt. You're concerned about overbuilding. You're concerned about pricing. You're concerned about tenancy. In other of the markets, I think you want to be equity. I think what we're watching is what I'll call this, global renaissance or industrial renaissance that is taking place. And the factors are not just the newfangled data centers. What's going on is nothing short of extraordinary. I mean, people forget the last 3 years in a row, the US has been the largest recipient of FDI. It likely will be again this year. Massive amount of building. 3 years ago in the US, we allocated money for infrastructure, all under construction. 2 years ago, $52 billion of semiconductor subsidies, not a single plant open yet, all under construction. A year ago, Inflation Reduction Act, $1.3 trillion, everything under construction. Defense, ramping up. And so what we're watching is just this incredible demand for capital happening against a backdrop of a US government that is running significant deficits. And so the capital raising business, I think that's going to be a good business.
Okay, that sounds very good to iBanks now time is running out, so I would like to put my last question to Goldman Stanley
Goldman Stanley.
yeah. Now, talking about Asia, and we saw a round of stimulus announced by the mainland authorities in September, and we saw very strong rebounds in the equities market in mainland China, but subsequently it's tamed down a little bit. Today, we heard some positive remarks from the Vice Premier, and we heard the statements by the main regulators in mainland China. So do you think investor would feel more assured, or if not, then what do you think investor would like to hear more from the mainland authorities before they regain a stronger confidence in Chinese assets? Maybe David, you go first.
Sure. You know, I think you've got a combination of issues that have global investors, you know, predominantly on the sidelines with respect to capital deployment, you know, foreign direct investment into China. And if you're looking for, you know, messages that can assist, you know, certainly some of the messages today are helpful about the continued opening up and the continued, you know, transition. But when I listen to global investors, one of the things they continue to be concerned about is they've put a lot of capital in, and it's been very difficult over the course of the last 5 years to get capital out. And so in that context, I think messages around the ability to both attract capital and have capital come in and come out are very, very important for global investors. And I think also the context of more confidence in the stability of the economy. There are a lot of things that are going well in the economy, but seeing improvement in consumption, you know, the stimulus was a first step, but seeing improvement in consumption in the economy, I think, is going to be very important to win back some of the confidence of the broad national investing community.
Thank you. Ted?
Yeah, I agree with that. Transparency is important, and battling deflation takes time. And so the monetary impulse is starting to take hold. Lower interest rates, more attractive mortgage rates, inducements to new ownership. The fiscal piece will take time. The real estate dynamic is going to take a number of quarters, and clearly there's focus on that. We should bear in mind, too, that 30% of disposable income is held in savings, average household in China. So that is a very strong number, and clearly the name of the game here is to reignite consumer confidence. And that's something that takes a while to take hold, but we're seeing some green shoots.
Can I mention one other thing I wanted to mention? Capital markets are hugely important. And, you know, continued progress in the opening up of the capital markets is hugely important. It's a huge advantage for the United States. The more you can broaden capital markets, the better in terms of ultimately that cycle of capital deployment, capital investment.
Second largest economy, second largest market as a liquidity matter. We all have many people in Hong Kong. We have 2,500 people. It's a great business to interact, and once that confidence starts to build, then the capital will move.
Yeah, absolutely. And that's why Hong Kong, HKMA, and all the Hong Kong government and all the regulators in Hong Kong really want to continue to build Hong Kong as a platform to facilitate the capital market efficiency for mainland China, mainland companies. This is the role that we are going to play. Thank you very much. Let's put our hands together to thank the panelists for a great session. Thank you very much.